Welcome to Power E-Trade Options Tools, Tips, and Tricks. I'm Sean Howell, and I'll be your guide for this short video. Since the platform is pretty comprehensive and this was designed as a short video, what I'm going to do is I'm going to break out 3 tools that I think are going to be most useful for you, and I'm going to give you 3 tips that I think will be helpful, and then finally I'll talk about 3 tricks as well that you can utilize in Power E-Trade. Thanks for joining. Let's get started. The first tool that I'd like to highlight is going to be the snapshot analysis. To get to snapshot analysis, I'm going to go to the trade button at the top upper right hand corner of Power E-Trade, and I'm going to take a look at GM here. I'm just going to put it in basic order to buy some shares. Buy 100 shares. We'll go in with a limit at the current asking price. Instead of going down to preview and then setting up the trade to execute, I'm going to go to snapshot analysis. From snapshot analysis, I have a risk-reward profile here indicating my maximum profit is infinite, my maximum loss of 5,930, and my break-even point, as well as a few key events to look for down below. There's also going to be what we call a hockey stick P&L diagram as well. Let's take this a little bit deeper and let's go and edit the ticket. And since we're teaching options here, let's go ahead and remove that and let's add an option, and let's indicate that we're looking to buy an option that goes out just about 1 month, and we're looking at about an at the money strike. So I'll take a look at the 59. Once I get this loaded up, we'll go in at the 59. 1 contract, April 09, 2021, 59 strike call option. I'll indicate that I'm okay with paying the asking price with a limit. You can see that's going to be $335 if I execute that transaction, but let's stop and take a look at the snapshot analysis and how it's changed. You can see that now it indicates that my maximum profit is going to be infinite, just like with the stock, but also it shows my maximum loss of $335, the cost of this 1 contract. It also indicates a probability of maximum loss just under 51%. It also indicates that I've got a break-even point of 62.35 and just under a 32% chance of achieving that. Events to watch out for indicate that I've got the expiration, which would be April 9th. It also tells me a key event like earnings that's happening May the 5th after expiration. I can also come over to my hockey stick diagram, and I can begin to move the price and start to simulate what my P&L would be. Down here you can see that there's a theoretical P&L at expiration determined by how I'm sliding the scale here, but also there's a theoretical P&L for the time present instead of at expiration here. And as you can see, the underlying prices I slide will change the P&Ls for both of those. Now, it works not just with simple options, it also works with complex options as well. So let's go back and edit this ticket, and let's add another option. In this case, we're going to make this a vertical spread, and I'm going to go with, let's just go up a few more points. Let's maybe go to the 62 here, going in at midpoint, and go back to the snapshot analysis. And in this case, you can see I've got my maximum profit and my probability of achieving that, my maximum loss, my break-even point, and also a risk-reward ratio, $1 to $1.48, and again, the events to watch for. And you can also see now that my hockey stick profile has changed, which gives me a better visual representation. This is one of my favorite tools, and it's one I think that is especially useful for people as they go from basic buying calls and buying puts to more advanced strategies like bull call spreads, iron condors, where they want a better visualization. That's the snapshot analysis as tool number 1. For the second tool, let's pick up right where we left off. We left off this bull call spread on General Motors with the snapshot analysis. I want to go a little bit deeper into this. And in order to get deeper, I'm going to analyze this particular trade setup in TradeLab. Once TradeLab loads up, it's going to give me the same information that I had from the snapshot analysis, although it's going to give me a slightly bigger representation of my P&L diagram here. What I particularly like about this is actually found in the lower right-hand side, and that is going to be the risk metrics. These are the what-if metrics for the spread that I just created. And from here, I could take a look at things like the delta, the gamma, the theta, the vega, and the rho. Now, if you're not familiar with the Greeks and you prefer to have these interpreted in English, I'm going to go ahead and change this from Greek to English. And now I can see that regarding this bull call spread on GM, price sensitivity is that this particular spread likes higher prices. In fact, for a $1 change, I can anticipate that it's going to increase by $15.16. I also understand that for a $1 change to the downside, that this spread is going to lose $15.16. Now, when it comes to sensitivity, I see that the price sensitivity is going to grow with higher prices. It will increase by 23 cents for a dollar change. This simply means that on the first dollar, I would make $15.16 if it were to go up. On the second dollar, I would make $15.16 plus 23 cents. You could just reverse that if you're trying to understand how this position would work if it was going against you. Regarding time decay, it does not like time passing. In fact, it'll cost about 16 cents per day. That would be something you would want to consider if we were going into a 3-day weekend. This way you would understand how this spread might change in value strictly from having a 3-day weekend if you were to put it on a day like Friday. How about volatility? It likes higher implied volatility. So if I was looking at this trade and I was thinking about volatility increasing because we were going into something like earnings or some other binary event, and I anticipated that the implied volatility was going to move higher or expand, I could see how this trade would benefit. And then finally, we've got rho, which is interest rate sensitivity. And in this case, it likes higher interest rates at about 55 cents for a 1% change. Although when you consider that interest rates do move rather slowly, this is certainly not one that you're going to want to be thinking about. So what I like about this is that it allows us to dive a little bit deeper into this. So this is the second tool that I wanted to share with you. The third tool that I'd like to share with you is one of our newer tools, and that's going to be the earnings analyzer. General Motors, if I want to see when this is going to release earnings, and it's the middle of March right now, I can go to the quote screen here. And it tells me that the next earnings will be about May 5th of 2021. Now, I can take a look at the earnings for GM, but it's not going to be all that interesting. Instead, let me pull up my watch list. And I know that there is a stock that I've been watching, and that's going to be FedEx, that has earnings coming up this next week. If I click on the stock on my watch list, it's going to pull up this other menu here where I can get quotes, charts, options, so on and so forth. And here's the new tool that we've added, and that's going to be the earnings analyzer. Even though we've got General Motors here, let me show you another way that we could get to it. I'm just typing in FedEx, and I can also see FedEx has an E right there. So when we get about a week from earnings, that little E is going to pop up on any of your securities, and you can click on it. So that's a second way that you can get to the earnings analyzer. What we're looking at here is the chart of the past 1 year. I can go back 3 years, 5 years, or all years, but I'm just going to stick with 1 year for this example. And it's color-coded, so I can see the options implied move. I can see when we had negative earnings move, positive earnings move, and the average implied. If I hover my cursor over the earnings that were released a year ago, March 17th of 2020, I can see that the options market was implying that after earnings that the stock was going to be up or down 12.78%. That was what the implication based on the valuations of what people were willing to pay for puts and pay for calls was sort of an estimate or an opinion of the market. The actual move, however, was just 4.97%. So people that were buying calls or people that were buying puts in this case were over anticipating the move in that case. If we look at the June 30th move, the implied was up or down 6%, but the actual was 11.72%. So in this case, the actual move was greater than the implied move. So the people that were buying calls or puts, in this case, calls, would have benefited from it as well. If we go forward and we take a look at what the market is anticipating for the March 18th move, the implication is that we're going to see an up or down 7.43% move, and we don't know what the actual move is going to be. Gives us that visual representation. Let's go over here to break it out a little bit further. We've got the earnings date after the market closes. We've got the current implied move, up or down 7.43%. We've got an implied dollar move that it's going to be between 250.12 and 290.28. That's what the market is anticipating or predicting. We've got the implied volatility rank at 8% with the current implied 37.95. So we're not seeing a lot of anticipated move from this, and therefore we're seeing kind of a lower ranking when it comes to the implied volatility as well. The average absolute historical underlying move has been about 5.74%. So the reason that I think this tool is going to be beneficial for option traders is that sometimes you don't understand, as we get closer to earnings, people that are getting started with buying calls and puts, they don't understand just how expensive the calls and puts have gotten in anticipation of a big move around earnings. This allows you to visualize it and also allows you to see how frequently the market has overestimated or underestimated the post-earnings move. And that's tool number 3, Earnings Analyzer. So that wraps up our 3 tools. We covered Snapshot Analysis, Trade Lab, and the Earnings Estimator. Let's move into tips now. The first tip is how to customize your options chain. Across the top, I'm going to select Options. You'll probably already notice that my option chains have different columns than yours, and that's because I've changed these and saved them a long time ago. The way that you're going to change yours is you go to the upper right-hand corner of the options chain where you see these 3 vertical dots. Click those dots. You'll see a Select Columns field. Click on that, and then I can see all of the different choices that I can populate my columns with, including the Greeks as well. I've kept mine pretty simple. I have bid, ask, theta, delta, gamma, vega, and then I've included probability of in the money, expiration, the at the money implied volatility. I can go to save, and it's going to save it. Let me minimize that down a little bit further. Once it's been set up, I can also change the columns around. For example, if I just wanted to get gamma and vega switched, I can grab gamma, drag it right over. Another thing that I can do is the strike prices here. You can see these little carrot chips. If I select one, it will push it to one side, and then I can bring it back. It's another nice thing. The other thing that I think a lot of people overlook about the option chain is in the upper left-hand corner. I'm currently looking at calls and puts. If I select the drop down, I can have this pre-build things like straddles and strangles, a vertical spread, and then it allows me some more fields that I can populate. If I'm creating a vertical, it's going to ask the width, the dollar of the width or the strike, number of strikes, dollar-wise or point-wise, the strikes, and if it's near a particular one as well. Taking it back from vertical, putting it back to call and put. I can also go to my strikes and I can select how many strikes I want to take a look at, and I can select how near I want it to be. So this is going to be tip number 1, how to customize your options chain, and once you've customized it, it will stay that way. Tip number 1, customizing option chains. On to tip number 2. To highlight the next tool, I have navigated to Accounts and Positions, and I want to show you how to get to the what-if scenarios for a part of the risk analysis suite. Here I've got Comcast, the vertical spread. Next to CMCSA, there are 4 little dots. We call those bentos, as in bento boxes. If I click on the bento boxes, you'll see that I've got the risk metrics on the left-hand side for this specific position. I also have a what-if box for this specific position. If I were to go through and say, what if the price were to move up 5% and volatility were to come down, let's say 3%, and all of that were to happen in 4 days, how would that scenario affect the P&L? It would generate positive $6.87. Just for fun, let's invert this, where we say that the stock were to drop by 5% and volatility were to increase 3%, and let's say all of that happens tomorrow. How should that affect the trade? Down $97.67. It allows me to see how various scenarios would affect an individual position. I've navigated over to the paper trade account. The paper trading is basically a simulator with $100,000 of pretend money in it. I came here because I want to show you the next tool, which allows me to look at the what-if scenario for an entire portfolio, unlike what I did at the demo, which was just look at the individual position. In order to do the what-if for the entire portfolio, I go to the upper right-hand corner where I find those 3 dots. On the 3 dots, I select them, and I'm looking for the portfolio bar. It's currently off. I'm going to click off, and that's going to turn it on. Now I'm looking at the entire portfolio for the portfolio analysis. I can compare the portfolio against a move in the S&P 500, SPX, the Dow Jones Industrials, the NASDAQ 100, or the Russell. So I've got large cap, I've got the industrials, I've got large technology type, and then I've got basically the small caps here. Let's say that my portfolio is generally large cap, so I'm going to use it as a comparison against the S&P 500. When I look at the what if, let me do the same scenario that I did where I say, hey, what happens if the stock were to move up, or I should say the SPX in this case, were to move up 3%, and if volatility were to go down 3%, and all of that were to happen in the next 4 days, how would that affect this overall portfolio? And I can see that a move of the S&P 3% higher with volatility down by 3 percentage points in a 4-day period would affect this portfolio by increasing it 8,965. Let's invert the situation where I say that the price were to drop 3% and volatility were to spike. Let's say that volatility were to go 6% and all of that happens tomorrow. How does that affect the P&L? That affects this overall portfolio down $7,816.45. I can also come in and adjust it to determine how it would be relative to the NASDAQ 100, the Dow Jones Industrial, the Russell, so on and so forth. That's tip number 2, risk analysis tools using the what if box. For the third tip, I'd like to talk about some order automation. In the account, I've got this Comcast vertical. I have the 50-55 call vertical. It's a bull call spread with 4 days to go with the underlying price at $57.09. At $57.09, since the current price is higher than the short leg, this is almost to maximum profit. The price point is at maximum profit, but I'm not going to experience maximum profit until we get 4 days out. I know the next 4 days are going to be very busy with meetings and with content creation and webinars. I simply don't have time to watch this. So what I want to do is I want to create an automated order that if the stock were to trade from its current level of 57.09, let's say it goes down to 56.09, then I want this call vertical to be closed out, even though it's not going to be at maximum profit. I want it to close itself out and capture whatever profit is still left when the price is at 56.09. Hopefully, we don't see that at all. Here's how I'm going to set that up. I click on Comcast vertical and I go to close. That's going to pull up an order ticket, a closing order ticket for the call vertical. I'm changing my price type to market because I don't know what the price is going to be if the condition is that the stock is trading from 57.09 all the way down to 56.09. I'm going to automate this by using the quote trigger, and then I'm going to go to the next step, which is create the trigger. The quote trigger is going to be good until canceled, even though there's only 4 days left. And I'm saying that when symbol CMCSA, when the last trade, or I can go off of bid or ask, I'm going to use last, is less than or equal to 56.09, so it's lost 1 full point, then I want to send this order when the quote condition is satisfied. And that order is going to be to sell one of the March 50-55 call vertical at market. I don't know what it's going to be at that time. If Comcast last traded less than or equal to 56.09, I go through and I read my preview. That's the order that I want to set. Then I send that order in. This is a way for me to set up an order that is based on the condition of the stock moving that will close out a complex position like a bull call spread like I have here on Comcast. That's going to be tip number 3, a way to automate it like a contingent order. Okay, so far we have covered 3 different tools. We have covered 3 different tips. Now let's get started with the tricks, starting with trick number 1. Trick number 1 is how we're going to enter an order and what's the most efficient way for us to do that. Let me show you a couple of different ways of doing it. If I start by looking at a chart and I'm thinking about placing, let's say in this uptrend on GM, if I'm thinking about buying an option that goes out maybe 90 days in this case with something that is in the money, maybe it has a delta of zero point 0.7 or higher. The natural way for me to do it is to click the trade button in the upper right hand corner. And by the way, you'll find that on every single screen in Power E-Trade, that trade button. If I select that, then there's quite a few keystrokes that I need to go through. One, I need to change it from what it defaults to, which is stock. I need to change it to call and put. And then I need to think, okay, what's out about 90 days? Do I need to go out to April, to May? What gets me out 90 days? And what strike price is going to come in right at about a 70 delta? That's quite a bit of extra keystrokes that I need to do in order to set that up. So once I've determined from my chart what I'm thinking about doing, what my opinion is as far as what the move is going to be, I've taken my notes. I'm going to, instead of placing it on an order ticket there, I'm going to take the shortcut and I'm going over here to options. And let me remove these. But if I put my cursor over each of these expirations, then it's going to pop up and give me an idea of how many days it is to expiration. If my goal is to get out to about the 90 plus window, well, I need to go, of course, beyond April. How about the June 2021 expiration that takes me out 95 days? If my goal is to be out more than 90 days, perfect. That would be the one that takes me out. My second objective was to find an in-the-money call option that has a delta of at least 0.7, and that takes me right out here to the 52.5. Now, I don't need to be writing these down. In other words, I don't need to go over to the trade ticket and then start selecting these. Instead, if I just go in and recognize that to buy the 52.5, if I click on the ask, then that's going to immediately load up the ticket for me. Pretty slick. From here, I can do my snapshot analysis. Now, if I wanted to take this and convert it from simply buying a call option to something a little bit more advanced, like doing a bull call spread, which would be a call vertical, I could change it here. Or the other way that I could do it, I'll minimize this to give you a little better view, is if I'm going to build the bull call spread, the call vertical, by buying the in-the-money option with the 70 delta, which has about a 61.5% chance of being in the money. And against that position, maybe I want to sell something that has about a 33% chance of being in the money. And that delta is right at about 0.42. That would be the 62.5. If I click on the bid indicating that I want to sell, you'll notice I've got green for the buy side of the spread, and I've got red for the sell side. And down here, you can see that the system has already recognized that what I am building here by clicking one leg at a time is a buy of one contract of a call vertical, and I've got that with a limit set up currently, with a maximum profit of 535, a maximum loss of 465. I've got a delta of 28.15 on the aggregate position, and it's going to debit my account about 465. From here, I can hop to the preview, or I could pull up the order ticket, review it a little bit more closely, determine if I'm going at the midpoint, or if I want to simply get the trade done at the ask. I tend to go in at the midpoint. And then from here, I could dive in deeper and do the snapshot analysis. I could go even deeper than that and look at the Greeks, or I can simply preview and I could place the trade from here, or I could edit it. So for me, this is the preferred way of setting up a more complex order by building it from the option chain. One more trick here before we close out this session. In the upper right-hand corner, you'll see those three dots. If I click those three dots and I've got the auto minimize off, I'm going to switch that on. Look what happens now. When I come back in and I click on the ask side, you'll notice that a ticket did not pop up. Instead, down below, it's giving me all of the data. So it kind of doesn't clutter up my screen. And against that position, if I want to sell the 62.5, it's the same thing, but it doesn't pop that window up and kind of distract me from what I'm trying to do. Now, another thing while I'm looking at it is if I kind of say, I think that that 62.5 with the 33.13% is just a little bit too close, and I'm going to back the spread away a little bit, I can take that and I can drag it down, and that rebuilds it. I can restructure this simply by dragging and dropping, and I can see how that changes the other variables associated with that. This is my favorite way. This is my trick when it comes to building spreads. And of course, I can get even more advanced, and I can start clicking and making multi-leg, four-legged spreads. Moving forward, you can see here, it's saying that's a custom spread. All right, that is number one trick on how to build complex orders from an option chain. Let's move on to trick number two. For the second trick, I would like to show you some of the tools that allow you to visualize volatility. Let's start by looking at the options chain on Boeing symbol BA. On the right-hand side, I've got the Show IV constellation. That's going to show the at-the-money volatility versus an expiration relative to one another. You can see that I have the solid line, and it's superimposed over the different expiration cycles. The solid line is the implied volatility over the 30-day average. And what I can see is a pretty normal curve here, where I've got the nearest term options that have the highest implied volatility, meaning they're the most expensive relative to the 30-day average. And as I go out in time, I begin to see these two converge so that they're almost the same as we get all the way out into August. Let's go ahead and compare and contrast that to something like Intel, symbol INTC. Let's see if we can see any anomalies here. I can see that for the March expiration that we've got the implied and the 30-day average about the same, and this stays true for the most part until we get out here till we see this spike. The spike around April 23rd, about 39 days out. Now, trying to figure out why would people be willing to pay more for this options expiration and this options expiration than they were for the one that was out, that was a little bit closer in or further out. Something must be going on that has people willing to pay more for calls and puts at that period of time. And here's my guess. My guess is that it's going to be an earnings announcement. So if the greatest implied volatility at 41% is being paid for the April 23rd option, let's see when the earnings are around this. So I hit quote, and I can see that the next earnings, April 22nd, and that's after the market closes. Going back then to the option chain, it should be clear now that what's happened here is that this is an earnings play that's going on. Now, this doesn't always happen. So for example, if we were to pull up something like Coca-Cola and see a spike, and then go and take a look at earnings, and we may not find that earnings are in that period, but maybe it's a peer. If I said this was Coke, then maybe Pepsi is releasing earnings, and the assumption by the market is that these two are going to be trading in tandem. So that's one of the ways that I can visualize it. Another way, let's go ahead and pull up FedEx, which happens to have earnings going on this week. You can definitely see that people are willing to pay much more with an 85 implied volatility over the 30-day average of 49%. And they're willing to pay that this week because earnings are being announced. So it's largely affecting the option. Now, we already talked about the earnings estimator or earnings analyzer estimator right here by clicking the E, but there's another way that we can visualize this as well. And that's to go to the chart. And what I've added in the chart is I've added volatility. And you can find volatility, you can add that as one of your studies if you want. But what I'm looking at here for FedEx, the red line is going to be the historical implied volatility, and the green line is going to be the historical volatility. So this is what people were paying for the options and thinking they were going to make these moves, and this is what the actual moves were. In other words, it appears that, now it's typical that implied volatility overstates and sometimes it understates. But what we're trying to ascertain by looking at this is, does the implied volatility overstate far more often than is realized, or a little bit less so? And of course, you can compare and contrast all of these. But these are two ways that when I'm trying to figure out, is the market over anticipating the move, I can take a look at where are they willing to pay the most. What does it look like historically? And of course, I can pop up my analyzer here and take a look what's happened over the past year or as far back as 5 years to see how the market's reacted. That's another way to visualize the implied volatility over the historical volatility. And that is trick number 2. And to wrap up this video, let's get into trick number 3. Trick number 1 and number 2 were relatively complex, but trick number 3 is quite simple, but I think it's something that you'll find to be useful. When we're looking at the overall platform, in the upper right-hand corner, you're going to find a cog. That's the settings cog. If I click the settings cog, one of the things that I like about this is the trade quantities button. I trade different numbers in different ways when I am trading equities versus options versus spreads, futures, so on and so forth. When I'm trading equities, I want my default trade quantity to be 100. And again, that's because generally I'm thinking about if I do take a position, maybe I'll want to write covered calls against it. Maybe I'll want to buy a protective put. So my default for equities is usually 100, and I can of course adjust that from the ticket if I want. The default trade increment is going to be 10, and then generally the default trade price for me is going to be at the market. I'm not usually looking to try to get in between the bid and the ask, because generally I'm trading something that's in the S&P 500 that has about a 1 penny spread between the bid and the ask. Now for options, on the other hand, I want to go ahead and set it up so that it's just going to be one contract, and the default, every time I click an up or down button or plus or minus, I want it to change by 1. And also with an option, because they're less liquid, the spreads are usually quite a bit larger. So the default in this case is going to be mid-market. And that's going to be the same true for spreads as well, because with a spread, I'm usually offsetting or deferring some of the equity risk. I'm generally okay with my default being 10, and again, my plus or down will change it by 1, and then I'm going to go mid-market. Let me explain what the other functions are here as well. At market, and the reason that I will not generally set that up for an option or for an option spread is because I don't want to do the trade at the natural market. When you have a multi-leg spread order, if you were to do it at the natural market, that means that you're going to buy at the ask and you're going to sell at the bid. I look at the options market as almost a negotiated market, so therefore I want to go mid-market. At market just means market price. With the market means that the order ticket will be set up at the natural market, which means if you are buying, then the limit price will be the ask. If you are selling, then the limit price will be the bid. I like that feature as well, that I can come in and I can customize these. And as you want to dial up your numbers, you can dial them up here or dial them down. The other thing that I think is kind of fun is going to be the notification settings. Not really a ton of utility in here, but it's a little bit fun anyway. From here, I can create notification sounds to have the order filled, to have a price alert, to have a rejected order, market open and market close. Now, I do not have the sound set up here because I don't want this making sounds when I'm doing a webinar or doing a recording like this, but I can create all sorts of different sounds. For example, I've got the boing sound here if I wanted. For the price alert, I can do a beep. For the market open, I think it probably makes sense that you would come in here and you would do a bell. And then, of course, I like the same for the close as well. And then from that, when I have a filled order or a price alert, then I can have the email message center, or I can have the mobile push as well. So just a couple of other settings here. And then the third one, and then I'm going to get to here, and then we'll go for the wrap, is the theme color. Generally, when I'm trading during the day or I'm doing some sort of presentation, I prefer to use the light mode, but sometimes at night, if I'm looking at charts, just really don't want it to be all that bright, so I will change it to the dark mode. And there you go. There's the dark mode right there. Now, the nice thing about this as well, besides the fact that you can customize it, is that I have different laptops or different computers that I'm trading on in my household. So, for example, I'm working off of my big iMac. Whatever changes I make on my laptop, which I'm on right now, will then show up on my big desktop as well.
Trick
So even
number
though I
2.
don't necessarily, when I go to save things, it's not just saving it on that one platform, it's saving it universally up in the cloud. And with that final trick, that is going to wrap up the Power E-Trade options tips, tools, tips, and tricks. I'm Sean Howell. I hope this has been a useful video. Wishing you much success in trading. Bye-bye.